In 2001, our firm had a financial crisis and I decided to shut down the firm.
What age were you at that time?
I was 30. Rakesh ji actually came up with 10 commandments for investing and 10 commandments for trading. The first commandment out of those 10 for investing was to be an optimist. And Mr. Jhunjhunwala was the ultimate optimist. Let me add one more thing that Mr. Jhunjhunwala taught us, and that was that your patience may be tested, but your conviction will be rewarded. There is a time to be brave and there is a time to be patient.
If you can give us what is your framework for mistakes in stocks so that I can avoid making those mistakes.
But I think making losses is a small part of the mistakes that you do. Opportunity costs is the much larger part of the mistake that you do. Opportunity cost is the largest cost which does not appear on your P&L. Second is you have to think of mistakes which are reversible mistakes and mistakes which are irreversible mistakes. Here let me quote Rakesh ji again, and he used to tell us, making a mistake is not a crime. Repeating a mistake is a crime.
Hey guys, I'm Sonia Shenoy and I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet impactful news and views along with the best and brightest minds in the financial world. Hey guys, welcome to the Money Mindset. Today we have Mr. Utpal Sheth with us. He used to be the CEO of Rare Enterprises. In fact, he's now doing multiple things along with, of course, being an equity investor. And, we're going to talk to him about his journey over the years, his association with various market veterans, and try and understand from him how you can build a portfolio of your dreams. Mr. Sheth, thank you so much. It's such a pleasure and honor to have you here on the Money Mindset.
Thank you, Sonia. The pleasure is all mine.
So, when we started chatting about being on the show, one of the big reasons why I wanted to chat with you is because of the vast knowledge that you have, the experience, and the several mentors that you met along the way. So, just start by telling us a little bit about your journey. And then, of course, we'll get to your investment framework, your philosophy, and all of that.
Sure, Sonia. So first of all, let me say that I've been very, very fortunate in having probably the best of the mentors, best of the teachers, and they've played such a huge role in my journey and in my life that I cannot ever thank them enough. The first introduction for me to my journey in the financial markets was actually during dinner table conversations with my father, who was probably the earliest exponents of equity research in India in the 70s. He used to be the head of research and portfolio management at JM Financial. And I used to be really interested in knowing about why stock prices were going up, why stock prices were going down, and so on. From a very early age, I actually started doing equity research at home under his guidance the day I finished my 10th grade exams. There were no computers in those days. We used to have newspaper clippings and so on. Thereafter, I joined ASK as an intern in 1988 and was very fortunate to work with Asit Kotecha and Samir Kotecha there. But the internship was so interesting, so exciting that I continued there throughout my college. So I worked at ASK along with my college and was heading research at ASK by the time, even before I was a graduate. That was fun. And those were early days in the evolution of Indian equity markets as well, research in Indian equity markets as well. After ASK in 1991, I joined my father, who had decided to move on from JM Financial and start out on his own. In that journey, we built up an organization from scratch, doing everything from institutional sales, equity research, portfolio management, corporate advisory, fixed income distribution, mutual fund distribution, and so on. My better half, Nipa, was also with me. She was looking after the fixed income distribution and the IPO distribution and the mutual fund distribution. In 2001, our firm had a financial crisis, and I decided to shut down the firm. And
What age were you at that time?
I was 30, and we dealt with the financial crisis. I took up a job at Inam. At that time, Inam was kind enough to give me that opportunity. And again, it was a life changing experience. I was very fortunate to have mentors like Vallabhbhai and Nimishbhai and Manish Chokhani there. And I was able to do some very interesting work there, though I'd never done investment banking before. So I was introduced to a new world effectively. And in 2003, I joined with Mr. Jhunjhunwala, and I was the first person to join Rare Enterprises formally, and ended up being CEO of Rare Enterprises. There was nobody else. And then Rare Enterprises has been probably the best part of my journey over these 22 years. We've gone from being effectively a investing and trading combination house to being the preeminent proprietary asset management firm model. At that time, there were no other proprietary asset management models. We were active both in public markets and private markets. We had no constraints. We did not have a fund life where we had to give back the money. And Mr. Jhunjhunwala empowered us fully. He was a visionary in many, many ways. You've known him. But once he would get his conviction, the way he would back the investment bets that we took was phenomenal. In general, he was a very impatient in his behavior, but in investing, his patience was phenomenal. The average time horizon for our investing used to be 10 to 20 years. Our average holding period in public markets was close to 10 years.
Per stock.
Per stock, on an average, in public markets. On the investing side, I'm not including the trading side.
Correct.
And on the private equity side, it's much longer. It's difficult to compute because we haven't exited most of those positions.
So, as you were saying, right, I mean, you've had the good fortune of being associated with Mr. Jhunjhunwala for over 20 years. I'm sure there have been several learnings in that which have helped you as an investor as well. For that young investor watching you right now, can you take us through some of those learnings which have stayed with you?
There are many, but the first thing, around the time that we started Rare, we came up with, Rakesh ji actually came up with 10 commandments for investing and 10 commandments for trading. The first commandment out of those 10 for investing was to be an optimist. And Mr. Jhunjhunwala was the ultimate optimist.
He was. He truly was.
Especially on India. He truly believed in India and its potential. And in 2002, June, Economic Times had asked Mr. Jhunjhunwala to write an article on the state of the markets. The markets were in dire straits in 2002. And he asked me to help him write that article, and we both worked on that article. And the article was titled "A Structural and Secular Bull Run in India." And when I read that article today, it's amazing to see how everything that Mr. Jhunjhunwala envisaged has played out. over such a long period of time, over more than 2 decades.
So, of course, there's one thing about being an optimist which has worked for a lot of long term value investors. But at this point in time, some amount of realism also is needed, right? Which I think he had. But how are you feeling about the situation right now? Because it's easy to have confirmation bias, it's easy to be an optimist. But what is hard is to sort of wake up and smell the coffee and realize that, oh, maybe now we could be getting into, say, a long period of consolidation in the market, or even a bear market for that matter, which hasn't come in over 4 5 years. How do you deal with a situation like that? And what's your view on the situation now?
Okay. So, before I respond to that, let me add one more thing that Mr. Jhunjhunwala taught us, and that was that your patience may be tested, but your conviction will be rewarded. Okay. There is a time to be brave, and there is a time to be patient. I feel that the markets were in such a state that there was some reality check which was required. And to some extent, we've had that reality check. I am not contemplating a bear market out here at this point of time. I feel that the correction has been a healthy correction. And more importantly, the quality of entrepreneurs, the quality of business models that we are seeing, the business environment, even if it is challenging, at least the quantum of protection that is there for investors is unprecedented today. We are not worried about the kind of things that were happening in the 90s happening today. But now, to come specifically to what you are asking, I feel that there is a unprecedented value migration taking place. Okay. And we've all heard of the term value migration, but let me elaborate what I mean by that. This value migration is taking place in multiple dimensions. Initially, it was from the unorganized sector to the organized sector. Then, from the weaker players in each sector to the stronger players in each sector. Now, the pace of technological disruption is changing so rapidly that the value is migrating from those who are less adaptable to those who are more adaptable.
Can you give me some examples of that?
I don't like talking about specific companies, but I'll give you an example. One of India's largest financial players, which is a large cap company, made a presentation about how they will be operating in the AI environment. It's a company that and a CEO that I respect enormously. And they said in that presentation that they are going to be growing at a particular pace, which would double their business in the next 3 years. But they also said that today they are operating a call center with 6,000 people. And they expect that in the next 3 years, that will go down to 1,500 people. So imagine double the business and one-fourth the people manning the call centers.
Wow.
This is just one example. Now, what does this do in the long run to the cost to income of such a player, which is clearly an early adapter, which has proven its execution prowess? If they execute so well in this AI era, so to say, we are looking at dramatically different cost to income ratios, which changes the business model upside down. And if the other players in the same space are not adapting accordingly, then how will they compete?
Yeah.
For all of these years, we are accustomed to looking at banks and NBFCs operating at 40 to 50% cost to income ratios. We are now talking of a scenario that they could operate at 30 to 40. In fact, this company is already sub 40.
Okay, so you were telling me that in your experience with Mr. Jhunjhunwala, one of the tenets of his, investing wisdom was to be an optimist? What else?
I told you the second one as well, which is your patience may
Your
be
patience.
tested, but your conviction will be rewarded.
Yes.
So he emphasized a lot on that conviction. The third was the power of compounding. And I think everybody talks of the power of compounding, but nobody's actually played it the way Mr. Jhunjhunwala has played it. Just to give you an example of his most celebrated investment, which is Titan, he started buying in 2002, and we still hold it, right? Over this time, of course, the company has done well. And there were so many people to whom Mr. Jhunjhunwala expressed his conviction about Titan 2. But most of them did not hold it for so long. So it becomes parabolic. This power of compounding becomes parabolic at some point of time. Therefore, the kind of returns that you generate with very long holding periods are disproportionate. Or to give you some other examples, we invested in these were private equity investments in companies like Metro Brands and Concord Biotech. And we continue to hold, right? So it's been a fabulous journey over 20 years plus. And these 20-year plus journeys end up giving us outcomes which are really mind-numbing. It's difficult to put down IRR numbers for that.
So when you pick a company and when you have conviction in that company, what is the process to go about it? How do you decide whether you need to raise your stake in the company, whether you need to buy more? At what point does your conviction dwindle a bit? Just trying to understand what are the red and green flags when you pick a portfolio stock.
So the style of investing that we practiced and that we advocate is what I call as terminal value investing. Whenever I would share that with Mr. Jhunjhunwala, he would say, "Tu teri Angrezi tere paas rakh."
मुझे सिंपल भाषा में समझा दो.
So this terminal value investing approach calls for holding for such long periods of time, having a vision about what this company could become, right? But to have that vision, you need three important drivers to be in place. The first is what we call as mega trends. That company should be pursuing a very large opportunity which is growing at a fast pace. If it is not pursuing a large opportunity, growing at a fast pace, then you are not swimming downstream. You don't have tailwinds. Okay. So megatrends is very important. However, megatrends is a necessary condition but not a sufficient condition. Because what we've seen is in every megatrend, there are few players which are able to extract the maximum benefit out of those megatrends. Those are typically the leaders within that space. And when I mean leaders, I don't mean the first to market. I don't also necessarily mean only the player with the largest market share, though the player with the largest market share is a leader.
And commands a premium.
But there is some attribute of leadership that they are demonstrating, that the company is demonstrating, that the management team is demonstrating, that the promoters are demonstrating. So we look for those leadership attributes. Okay. It could be cost competitiveness, it could be having the best distribution, it could be having a business model which is different or a revenue model which is different. It could be a distribution network which is built differently. It could be just brand loyalty that is already established and so on. So we look for those leadership attributes, and those leadership attributes we call as intangibles. So this is the third component, the intangibles. Now these intangibles manifest into that leadership, which is a sustainable leadership, where you keep widening the distance between yourself and the next competitor, where you keep participating in a virtuous cycle, where the flywheel is working in your favor. And this has played out across many companies over a very long period of time. Does it mean that every company that we invested in was successful? No. We had our share of lemons. Okay. And in fact, in the past, I have made a presentation on not just mistakes, but a framework for mistakes. So these three factors, megatrends, leadership, and intangibles, together make those companies, those compounding machines. But a compounding machine only works if you have the conviction and the patience to carry on with that. And I loved the fact that you brought out about how you add to your positions. In the day and age that we are in, most people would sell a position 30% higher.
Correct.
I have seen Mr. Jhunjhunwala add to a position 30x of his first purchase cost. That requires tremendous conviction.
But don't valuations play a part there?
Of course, valuations play a part there, but valuations have to be looked at in the context of the probability in your mind about the terminal value. If the terminal value is very high and the probability is very high of that company achieving that terminal value, you're willing to pay higher prices. Okay. Sometimes the valuation paradigm also evolves. You invest in a company under one set of assumptions, and that company then demonstrates something else. So we have this framework, which we call as the 5L framework for promoters and management teams. The base of that 5L framework is what we call as companies which are really not all that great. Okay. And I won't use the terminology for that. The second one is what we call as losers, where the management teams or the promoters are over smart. Okay. They end up taking decisions which are short term in nature, compromising the long term outcomes. The third one are laggards. Those are management teams or promoters which understand strategy but lack execution. Then there are leaders, which the companies which understand both strategy and execute very well. But beyond the leaders is legends. This legends category is very rare. And these legends categories are promoters and management teams which are able to replicate their skill sets and competitive advantages across categories, across business models, across geographies. Obviously, legends are very rare. But this terminal value that we are talking about is applicable really only to the top two categories, the leaders and the legends. It is not applicable to the other three categories. And what was the best way to capture this analogy? Right? And we said that, look, these really special companies which have those intangibles which make them leaders and who are participating in a large mega trend are actually gorilla companies. Why gorilla? Because gorillas are large creatures, strong creatures, right? So they depict dominance, they depict resilience, they also depict strength.
And they are rare.
And they are rare, right? So gorillas are rare in any jungle. You will find very few gorillas. You may find many of the other animals. They are also such that other animals keep a distance from them. moats that we are looking for,
Correct.
right?
In a business.
And lastly, but most importantly, the average lifespan of a gorilla compared to, let's say, monkeys, who are also from the ape family, but the average lifespan of gorillas is double that of monkeys or of other apes. So longevity is a very essential criteria of these gorilla companies or companies that create tremendous value. So to put it all together, if you were invested in these gorilla kind of companies with adequate conviction and patience, then you may start with a 5% position in your portfolio. Over time, it becomes 10% and then it becomes 15%. And there are times when it becomes 20%. Now, sometimes you get there, the 5% may get to 10% just by compounding at a faster pace than the rest of your portfolio. But sometimes it becomes higher portion of your portfolio because your conviction in that company keeps on increasing and you keep adding to those positions, which is the example that I was giving you, that he added at 30x of his first purchase price.
So, just for the benefit of our viewers, right? It's very interesting, this gorilla company concept to me, because as a small investor myself, I'm always doing research on individual companies, trying to find out which small cap can become the next mega cap, right? Can you help us with some examples? Maybe not companies listed here because of compliance issues, but maybe global companies. What is the definition of a gorilla company?
Okay.
If we can take some case studies.
Sure. So let's take something that all of us would be very familiar with. Let's take Amazon. Okay. Amazon was a company which came in as a disruptor. It was disrupting the then prevailing retail model. As a disruptor, it started with just books, digital books, and kept on adding categories and expanding, which is what I said, replicatability. Remember? So this company demonstrated replicatability. Not just did it expand into various categories, it kept on expanding the number of SKUs, it kept on expanding geographies, and kept on scaling. For a disruptor to be able to do that, for a long time, this company did not get valuation because especially after the dot-com bubble, on the grounds that it was loss-making. What was really important to understand was that it was a company with negative working capital. Even though it was loss-making, its operating cash flow was positive and significant and growing. And its capital intensity was not that high. Its incremental operating cash flow divided by incremental capital employed was still fantastic. So it was demonstrating superior characteristics to the conventional business models, along with those intangibles that we were looking for, right? So you had the mega trend in place, which was e-commerce disrupting conventional retail. You had a leadership in place, and you had intangibles in place. It turned out to be a gorilla. It has given fabulous shareholder returns. Just putting this together, if you had made Amazon 5% of your portfolio in 2001, 2, or maybe 3 also, it would be easily close to 10-15% of your portfolio today.
Any examples of global companies that could be gorilla companies in the future over the next 5 to 10 years? I mean, of course, as we speak, there are so many, right? There's Nvidia that's growing at a fast pace. There's Palantir that's growing at a very fast pace as well. But in your assessment, any of these companies that could be the gorillas of the future?
I think very, I would say they are already gorillas in many ways. Okay. But look at how they are evolving and expanding their TAM, their total addressable market. Palantir was predominantly um, servicing the US government
Yes.
for all its AI capabilities. The moment they moved on to enterprises, global enterprises, they expanded the addressable market dramatically. Then the question was, how fast can you tap into that much larger addressable market? They are demonstrating that with their AI platform. And the adoption rate for AI is the fastest that mankind has ever seen for anything. It's faster than that for internet, it's faster than that for computers, it's faster than that for mobile phones.
Absolutely. No, no. I mean, and the funny part is maybe 10, 15 years back, there were technologies that came and then they stayed for 3 years, 5 years, 6 years. Right now, the situation is such that technologies are changing rapidly, right? I mean, until 2 months ago, DeepSeek never existed. Now AI is threatening AI. Now that is how we are. I mean, that's how today's world is, I guess.
Yes, it is. But as an investor, you will look for that adaptability characteristic in management teams. Right? So, the finance company example that we talked about, it's it could have continued doing its business in the conventional way.
Correct.
There was no pressure on them to do AI, but they are embracing the change.
Correct.
Those who embrace the change and position themselves accordingly will obviously reap the benefits. And the benefits are not always in terms of just profitability, it could be scalability. So, we have one more framework to talk about. In every sector and even in new sectors, you find incumbents and you find challengers,
Correct.
right? Incumbents already have scale and challengers don't have scale. But challengers have agility, which incumbents don't have typically, right? So, what kind of companies are we looking for? We are looking for adaptable incumbents and scalable challengers.
Any examples that you can share with us for better understanding?
Sure. So,
And full disclaimer here that these are not recommendations or advice in any way from your end, but just for educational purposes and just so that our viewer can understand how to navigate through some of these sectors.
sure. So, to continue with our earlier example, Amazon was a scalable challenger in early 2000. Today, it is an adaptable incumbent. It's already established itself. It has the scale, it has the reach, it has everything. It went on from just doing e-commerce to becoming a global leader with its AWS offering and has its play for AI as well.
But do you feel that it's better to invest in a scalable challenger rather than an adaptable incumbent because maybe the story has already played out with something like an Amazon? Or do you think it's just safer to pick an adaptable incumbent?
See, um, one should not think unidimensionally, which means you don't always think about is this company a buy, hold, or a sell. You also have to make decisions in the context of your portfolio. I think every portfolio requires a combination of scalable challengers and adaptable incumbents. You cannot have a portfolio all of adaptable incumbents. Okay. The way we think about it is to look at companies with another metric, which is clear leaders near leaders and emerging leaders. So that we will invest with leaders is a given. In these three buckets, typically the challenges are in the emerging leaders bucket. Your portfolio sizing, bet size, timing, all of that is different for emerging leaders than it is for clear leaders. In clear leaders, these are battle tested management teams and promoters, battle tested business models which have demonstrated resilience through multiple economic cycles and so on, right? So you need that ballast in your portfolio so that you don't have sleepless nights when there is turbulence. But at the same time, you need this emerging leader bucket in your portfolio also to give you the optionality or convexity in your portfolio, which can be non-linear. The adaptable incumbents will, for most parts, be linear and will have some element of non-linearity. But the emerging leaders will have a far greater element of non-linearity.
So by non-linearity, you mean that there could be a lot of drawdowns as well before the big up move takes place in
I'm saying
emerging.
higher degree of risk,
High degree of
but on both sides. So if there is an upside, it could be just an explosion of upside.
So who do you think the emerging leaders of the global market could be over the next 5 to 10 years?
Um,
In terms of sectors, spaces, companies.
sure. So I feel, and we've all heard all the excitement about AI around us right now. I don't see that as a fad. I see that as probably the largest mega trend that I will see in my lifetime. I see it as, there's this fantastic book by Alvin Toffler called The Fourth Wave. I think first he wrote the third wave and then he wrote fourth wave, if I'm not mistaken. He talked of the agricultural revolution, then the industrial revolution, and then the information age. I think we are in the intelligence age now. And that is a dramatic difference. Those who perceive this change, embrace this change, and adapt to it will win in multiple ways, and value will migrate to them. So it's not that you have to be an AI player only for the investor to make money. I gave you this example of this finance company where you are not it's not an AI company, but effectively it is embracing AI and adapting so beautifully.
So AI will continue to be the big trend of the future as well and could disrupt a lot across sectors is what you're saying.
Yes.
Okay, that's interesting. You mentioned very briefly to me there's a framework for mistakes that you make. And that's very interesting to me because, we always talk about our successes, but we talk fairly less about our mistakes. I think there's so much to learn from failure, right? If you can give us what is your framework for mistakes in stocks so that I can avoid making those mistakes, and with some examples would be helpful.
Okay. So conventionally, we talk about mistakes only in the context of where we have made losses. But I think making losses is a small part of the mistakes that you do. Opportunity costs is the much larger part of the mistake that you do. I tell most of our investee companies that opportunity cost is the largest cost which does not appear on your P&L. Right? It's the opportunity cost of making the wrong decisions. So when you think of mistakes, you must widen the perspective to include opportunity costs and not just losses. Second is you have to think of mistakes which are reversible mistakes and mistakes which are irreversible mistakes. They are two dramatically different things. Okay. And in here, let me quote Rakesh ji again. And he used to tell us, making a mistake is not a crime. Repeating a mistake is a crime. Not learning from a mistake is the worst crime. Right? So embrace mistakes. Don't have mistake aversion. If you have mistake aversion, you will lose out on a lot of opportunities. Don't be afraid of mistakes. But make mistakes that you can afford. Manage risk in such a way that it does not demolish your portfolio, right? The second thing,
In your journey, stock market journey, any mistakes that you can tell us about that you made and you learned a lot from stock wise?
yeah, again, as I said, I don't want to talk
Sure,
about
sure.
specific stocks, but in that presentation, I have shared specific ones. But let me share with you the concept, and
Sure.
it will help put that in context. The second element that I wanted to bring home here is that we've learned about errors of omission and errors of commission in economic terms. These are ways to classify your mistakes. But in statistics, there is type 1 mistake or type 1 error and type 2 errors, which corresponds broadly to that error of omission and error of commission. So we have only two buckets for mistakes. I strongly feel that there is a third bucket of mistakes, which is not quantified or which is not well recognized, and I call that the type 1.5. And this is the error of hesitation and reluctance, where you come across a compelling idea, you build your conviction, but either you are reluctant or you're hesitant, you're influenced by the volatility or you're influenced by the noise or the news flow around you, and you end up making it a subscale position. And it's okay if you make a subscale position. How quickly do you recognize your mistake and scale that position is important. The human behavioral tendency is that if you bought a stock at a particular price, it's difficult for you to buy it at 50% higher, difficult to buy it at double that price. So, way back in 2003, there was a company based out of Pune that I had liked, and I took it to Rakesh and he said, "Are you crazy? This company has already been a 10x in the last 9 months. I don't believe in buying companies like that." He said it in much more colorful terms.
I can imagine.
Then I said, okay. I met the company again in another 1 month and went back to Rakesh and I said, we can't miss this company. And he said, look, because you are so insistent, I will go ahead with this investment, but you will live to regret it. And I said, okay, let's see. I really have a lot of conviction here. And we invested. Promptly, the stock went down 25%. And he said, look, I told you. So now let's at least take the tax loss here.
Yeah.
And you transfer it from my account to Bhabhi's account. And I'm talking of 2003. And from there, the stock became 50x
Wow.
in 4 years. Okay. When something like that happens, okay, it's a question of conviction. Rakesh, while initially skeptical, built so much conviction himself. Subsequently, we did not sell at any point of time in that journey of 50x thereafter. I really respect Rakesh for that ability to revise his point of view. He had a very iterative mind. Like Jeff Bezos says, strong opinions held loosely or weakly, right? He had very strong opinions. But when he heard a good argument, he would revise his opinion. And sometimes, if he's not convinced, he would hold on to his opinion, and that paid off handsomely. There was this automotive company that Rakesh ji had invested in, and he would recommend it to everybody he would come across, and everybody would not be convinced. But he held on to his conviction, and that stock became a huge 20x for Rare. Today it is more than that, 40x. So I think knowing when to hold and knowing when to evolve your opinion was one more important learning that I had from Rakesh.
Okay. So many learnings that we've covered up until now, whether it's patience, power of compounding, knowing when to hold. Anything else that stands out for you when it comes to learnings from Rakesh Jhunjhunwala?
He also used to say that investing is an act of wisdom. It's not an act of intellect. And I think that's a very powerful statement.
Tell me more.
So, intellect is your ability to analyze, your ability to look at information, decipher it. But wisdom goes beyond analysis. Wisdom needs synthesis. Wisdom is pattern recognition. Wisdom is an evolved mind. Right? So, as they say, at 20, if you are
But does wisdom come with, wisdom generally comes with time, right? So for young investors, how do they cultivate that?
see, there are two ways to learn. You can learn from your own mistakes, or you can learn from other people's mistakes, right? I think the kind of access to information that is available today is unprecedented. Your ability to learn from other wise people is that much greater today than it was before. Like in the good old days, there used to be a very wise investor, Mr. Chandrakant Sampath,
Yes.
whom we all used to look up to. Okay. And of course, there are many other great investors today, which we all look up to. So that distilled wisdom was available for the taking. Those investors were generous enough to share. And you have known Rakesh. He was generous enough to share his thoughts, his wisdom in multiple ways.
Absolutely.
Everyone, each and everyone. It's up to each one of us of what we learn from them.
So apart from Rakesh ji, there were so many other mentors and people that you had the privilege of being associated with, right? Whether it was Asit Kotecha, whether it was Vallabh Bansali ji, Radhakishan Damani, that whole, that whole group of legendary investors, and you were right at the, forefront of that. What are the 3 or 4 lessons, apart from the ones that you spoke about, that you learned, imbibed from Rakesh Jhunjhunwala? But who are the other mentors who influenced your investing in a big way? And what are the 2 or 3 key lessons that you learned from them?
So one of the things, earliest lessons that I learned while I was at ASK was that how you position yourself is as important as your conviction. So in those days, we had analyzed the cement sector and had built up our conviction in the cement space.
Okay.
Okay, and there was a significant trading position as well as investing position that was built. And I'm talking of 90s now, I mean, late 80s, early 90s. And there was interim volatility, massive volatility. And our trading positions had to be liquidated. And we had to reduce our investing positions because of the impact of the trading positions. But the lesson there was, if the initial position was of zero trading and only investing the same quantum that we did invest. I'm not saying we should have done more. I'm saying whatever ASK had invested at that point of time, what it would have become in due course was so massive because its conviction was right eventually. But the interim volatility caused by that trading position had an opportunity cost.
Okay.
So, positioning yourself right is, I think, one of the great capabilities that all these named investors and famed investors that you talked about have.
So, for an average investor who's starting off their journey now, right, for a 25, 30-year-old who maybe has not seen too many bear markets, I think the last bear market was in COVID. And at that point, it was a very different kind of a situation because a lot of people lost their professions and vocations along with their, market wealth. So it was unique in a way. But for that young investor who's starting afresh now and who hasn't seen a big bear market, what would your advice to them be? How do they go about this journey of creating a portfolio that will create wealth for them over their lifespan?
I think the first thing is that don't expect results overnight. Everybody has that excitement that today my stock is up 10% or 20%, whatever. But don't expect that overnight. Allow for the power of compounding to work in your favor. The second thing I would say is follow your convictions. Each person has certain, I use the word differentiated insight into something or the other, no matter what you are doing. You don't have to be in the financial markets to have a differentiated insight. You could be somebody in the chemical sector, hypothetically, but you would understand that space very well. And the day you get a differentiated insight about that space, you will find the investment opportunity for the long term. We are not talking of any information edge here. We are talking of that differentiated insight for the long term. Effectively, we are talking of wisdom here. That gives you the ability to make a significant conviction led investment in any company and make it a meaningful part of your portfolio and ride it for the long term.
But when you talk about long term, when you see a drawdown of 20%, 30% on a stock, and it does come, right? Any stock, I mean, if you've held it for 5 years, in that 5 year journey, there will be a period when, due to any issue, whether it's a bear market or whether it's some promoter issue, something happens, some tax or anything. I mean, I'll just give you an example of when Polycab was going through a dream run. And there was, I think, this issue of some IT raid that had taken place in some of its premises, and the stock fell about 20%, I think, in over the next couple of weeks. Now, of course, great company, super growth, great business, all of that. But at that time, and disclaimer, I did hold, investments. At that time, there was this brief period of like, oh, you know what, I'm sitting on profit, should I book out? So what do you do in a situation like that?
So this is where your patience is tested, but your conviction is rewarded. So it is up to you to have that conviction in that company, its business model, its management team, its execution, its strategy. If you had that conviction,
You need to ride it out.
it will not impact you. It is only when your conviction is not strong enough that you will be thrown off.
But in such a situation, it's not market volatility as much as it is about a particular incident with the company.
Of course,
So you let some of those pass if you believe that the larger, growth story is intact.
absolutely.
Okay.
Why not? Because think of it this way. We talked about you need both courage and conviction to buy,
Correct.
right? But what do you need to hold? You still continue to need conviction, but you need patience and equanimity to hold. Okay, equanimity is your state of mind. Don't allow things to impact your state of mind. At the same time, does not mean you don't revisit your assumptions. Okay, sometimes there are certain developments which are a fundamental break of your hypothesis. If that happens, then you must take action. But so long as your core hypothesis on which you build your conviction is not compromised, then you should have that equanimity and patience to allow other noise factors, including these kind of one-off factors, to pass.
Okay. Ms. Sheth, were you born into wealth? I'm just trying to understand what was your early years like, and now that you have achieved this kind of growth, wealth, value in your career, how has your own equation with money changed over the years?
So I was born in a very humble background, but with a wealth of knowledge and wisdom from my dad. So I think it's very important to have what we've always grown up hearing the word sanskar, right? So if so long as you're born rich in sanskar, you're okay, right? The uh, wealth is not that critical. And I don't think of it as having achieved a lot over this time frame or any such thing. I think it's a question of journey. Rakesh ji always used to tell us, हम साथ लेकर ऊपर कुछ नहीं जाने वाले हैं. So that journey of learning, that journey of participating in value creation, and I distinguish between wealth creation and value creation. When you are to me, wealth creation is a function of value creation. The companies are creating the value. As investors, we are participating in that process, right? And we respect the promoters and management teams for that. And they respect us for recognizing those intangibles in them. So it's that journey where value creation and wealth creation end up in a virtuous cycle. And it is a very satisfying journey to see those companies grow, become world leaders, or become the best in class companies in their own way. And I think that is a far greater wealth.
So, what does money mean to you? And I'm asking you this question because I ask this to a lot of people who are successful and wealthy. And they say that money doesn't bring you happiness, but they say it at a point when they have enough of it. So, what does money mean to you?
Money is a means to an end. To my mind, every person has to be clear about what their purpose is. They say only two moments in your life matter. One, when you are born, and two, when you realize why you were born. So, find your purpose. If you have all the money in the world and no purpose, I don't think it's great. So, if you have a purpose and you have money, that's phenomenal, right? But if you have purpose, you don't have money, you're working towards your purpose. If you do it right, in due course, money will come. As we saw in that movie Three Idiots, right? Pursue excellence, success will come.
So, have you been able to find your purpose, or are you still looking for it?
See, I can only say that I feel that I have found my purpose and I'm working towards that. And this purpose is something that one has to be passionate about, one has to deeply believe in. And I am doing that. I'm in that journey. And it has been a very satisfying journey. There's so much about life, about people that I learned from Rakesh ji. I did not just learn about markets and companies, but I also learned about life and people from him. And for that, I'll forever be grateful.
So, when you say learned about life and people, what is your biggest lesson?
That people make all the difference. People choices make all the difference. Rakesh ji had great conviction in the people whom he
Partnered with.
partnered with. It need not be an investment alone. Okay, he valued relationships beyond just the financial outcomes, and I think that was a very important lesson. Rakesh ji would say that we must value people for who they are rather than for what they have, and I think that's so true.
But do you think that exists today? Because every person comes to the table with some value.
Sure.
Stripped of that value, who are we really, right? I mean, that's just how the world works now.
Of course. But let me point out that it's also your ability to judge people. And Rakesh ji had an outstanding people judgment. His ability to realize that we made a mistake with this promoter, even when that company was doing well, was phenomenal. But more often than not, his conviction in people was exemplary. I remember in the year 2000 or 2001, he called a lot of his friends and had a party, and in that party there were 10 people that he gave a small award to, and people whom he recognized in his life. There was no financial transaction here, okay? There were just 10 people that he called from the capital markets. And today, all 10 of them are immensely successful, and successful not just in monetary terms, in multiple ways. I think it is Rakesh ji's credit that he identified those 10 people, kept them close to him, right? Interfaced with them in multiple ways, and so on.
Interesting.
So, people judgment, I think, is very vital.
Okay. Not just in your investments, but also in the people you meet in your life, right? Your personal relationships, your professional relationships. But it's interesting because they say that you don't choose a lot of people that you spend your life with, whether it is your parents, whether it is your children, whether it is your siblings. You don't choose anyone, right? They choose you, I guess. Or you just handed them. I think when he talks about people, he means more about the professional side of things or the relationships that he's built outside of his family.
True that. I'm talking about that. But it's while you don't choose your family, is true. But how you engage with your family, how that relationship evolves. Just because you are related to someone is not enough. That relationship between the two people is still something that you choose. You don't choose how you are related, but you choose the depth and the intensity of that relationship. You do make a difference in how that relationship evolves. You do make a difference in each other's lives.
Do you think somewhere in every relationship, money plays a crucial matter? And I'm not talking about family as much as I'm talking about professional relationships. Your peers, your sort of industry people. Do relationships strengthen or weaken depending on how much money you have? Is that something that you have noticed in your journey?
See, I feel that there are people who are influenced by how much money each one has, and there are people who are not influenced by that. I think over time, you realize the difference between the two, and accordingly, you keep the relevant people around you. Okay. Now, there are some people who will make value judgments about others, and some who will hold the judgment back. I don't see relationships which are based on money, as you call it, sustaining for very, very long. Eventually, one of the two will realize what the driver in the relationship is, and that's finite. I think um, one has to think of it in a larger, wider context. While life is finite, but relationships and um, investing for me is actually an infinite game.
Because I notice a lot of people who I talk to, wealthy people, successful people, have the same set of friends that they had when they were kids or when they were in school or college, right? Once the professional journey began and the growth has been sort of exponential, the kind of relationships that they have built with friends or colleagues or peers is very monetary led. And the reason I'm asking you this is because it's common that people who are the most successful, they will still go back to those four friends that they had from when they were in school. Is it because your relationship with money gets colors a lot of your relationships with other people over time?
Okay, let me share my personal example. Um, when I first met Rakeshi, I was a nobody. I still am in many ways, but Rakeshi was a true friend in every dimension. He was much more than a friend, I would say. Apart from a friend, he was a philosopher, he was a guide, he was a mentor, he was an elder brother, which is why we used to call him Bhaiya. And even when I was in difficulties, my relationship with him did not change. His relationship with me did not change. In the kind of support that he provided in my darkest days is something that I can never forget. And he had nothing to gain out of it. There was no money involved. And there was no hope for any money to be involved in any way. Right? And he did it selflessly. And not just Bhaiya, but also Bhabhi. So I can only tell you that I've been very fortunate to experience a lot of relationship which were not driven by money, and I hope and pray that I continue to be that fortunate.
So there's a concept that you were talking to me about called creative destruction. Tell us a little bit about that and how do investors use this in their investment framework?
Creative destruction was a concept that was advocated by Joseph Schumpeter. It talks about how there are economic cycles and business cycles, and how those economic cycles and business cycles are actually driven by innovation and overinvestment and underinvestment. Um, while this is a theoretical concept, let's see how to connect it to the concept of value migration that we that we talked about earlier. So, in creative destruction, uh, there is one part of the economy which is not adapting, and that part of the economy loses value. And that the newer part of the economy which is adapting is the part which is creating value. That is why creative destruction, and that is why value migration. To give you an example, rather than talking about companies, if we talk about sectors or segments, then what we've seen is how value has migrated from the conventional power sector to the renewables sector, right? You've seen so many companies getting listed in that space. You've seen the kind of multiples that they enjoy and the kind of valuation that they are getting and the value that they have created. So this value migration that takes place within the context of creative destruction is driven in by multiple factors. One, customers start moving towards the new variable rather than the old variable. Two, capital starts moving towards the new variable rather than the old variable. And only after both customers and capital start moving there, that value starts moving towards the new variable. So it's imperative to be cognizant of what are those big shifts that are taking place, which we call as mega trends, and participate in that value migration process so that you are not hurt by the creative destruction, by the destruction part of creative destruction.
So you spoke about value migration from traditional power to renewables. Is it safe to say that even, there's value migration happening from, say, traditional FMCG companies to maybe some of the quick commerce companies, which are growing in a big way, although it's questionable about, profitability and all of that. But is that a fair assumption as well?
So think of it this way: the conventionally the FMCG companies uh, in had much higher margins in India than in other countries. So they were making margins for their brand, but they were also making margins for their distribution. What we are seeing is a shift in the power of the distribution and in the value of the distribution. We are seeing the e-commerce and quick commerce platforms creating distribution networks which are independent of the conventional distribution networks. And as they keep becoming a larger and larger percentage of the sales of the conventional companies, then the terms of trade will change, and then value will migrate. So one should be very cognizant of this shift. It will take a long time to be fully visible, but you're right, the shift is happening as we speak. But both sides will evolve and both sides will try to find value for themselves.
This was really an amazing discussion, and I didn't realize how 1 hour has passed. Thank you so much, Mr. Sheth, for joining us. It's an honor to be in your presence and to learn so much from you. You have so much wisdom to share, and thank you for sharing that with us today.
Thank you, Sonia. It was my pleasure. Thank you for asking very thought-provoking questions. Really made me introspect in many ways.
And hopefully, we'll meet again very soon.
I look forward to that.
Thank you for being on the Money Mindset.
Thank you.